All right, let's talk about something that happens in those few seconds after you've already decided what stock to buy. It's a choice that honestly can have a huge impact on the price you actually pay. We are talking about stock market order types. So you've done all the hard work, right? You've researched the company, you've picked your stock, you're ready to pull the trigger. But hitting that buy button, that's only half the battle. The how is just as critical as the what, because how you place that trade can seriously change the price you end up with. And that how, well, that's what we call your order type. Think of it like this. It's a very specific set of instructions you're sending out. You're not just yelling buy into the void. You're saying buy, but do it this specific way. So let's break down the most common instructions you can give. First step is the most fundamental, the most common one of all, the market order. This one is all about one thing, and one thing only, speed. A market order basically tells your broker, look, I don't really care about the exact price down to the penny. Just get me into this stock or get me out of it as fast as you possibly can. It's all about prioritizing speed. Your order essentially jumps to the front of the line and gets filled almost instantly at whatever the going rate is at that exact second. And that brings us to the crucial trade-off. The big plus? It's simple, and it is lightning fast. Your trade is pretty much guaranteed to happen. But the downside is a big one. You have zero control over the final price. If the market ticks up or down in that split second between you clicking the button and the order actually executing, well, you're going to get that new price. We call that slippage. So when would you use this? Well, think about a long-term investor buying a huge, stable company where a few cents difference isn't going to make or break their decade-long plan. Or maybe it's a trader who sees some breaking news and needs to get out right now, accepting that price uncertainty just for the sake of pure speed. Okay, but what if you do care about the exact price? What if you want to be the one calling the shots? Well, that leads us right into our next order type, which is designed to fix the market order's biggest flaw. A limit order puts you right in the driver's seat. Instead of just saying, buy now at any price, you're saying, hey, I only want to buy if the price hits my target or, an even better one. Let's make this super clear with a quick example. Imagine a made-up company, we'll call it Innovate Corp. Right now, it's trading at $50 a share. You like the company, but $50 feels a little steep to you. Using a limit order, you can send out an instruction that says, I'd love to buy 10 shares of Innovate Corp, but I refuse to pay a penny over $49.50. And then your order just sits there, patiently waiting for the market price to drop to your level or even lower. And here you see the exact opposite trade-off of the market order. The pro is fantastic. You have total control over the price. But the con is just as big. There's absolutely no guarantee that your trade will ever happen. If Innovate Corp stock never dips down to $49.50, your order will just expire, unfilled. This is really the go-to tool for an investor who's done their homework and decided this stock is only a good deal at this specific price. They are perfectly willing to miss out on the trade if the market doesn't come to them. It's all about precision over speed. Okay, so we've covered speed and we've covered precision. Now let's talk about defense, about protecting your investments. Stop orders, they're kind of like having your own automated agent who just watches the market for you, ready to spring into action. The most common version of this is the stop-loss order. It's an order that literally does nothing until the stock price falls to a specific level you set, which we call the stop price. The second it hits that price, bam, it instantly turns into a market order to sell. Its main job is to be your safety net. Let's say you bought Innovate Corp at $50. You might place a stop loss at $45. If the stock starts to tank and hits that $45 mark, your order triggers and sells your shares automatically. It's your emergency escape hatch to prevent a small loss from turning into a huge one. Now, for a slightly more advanced version, the stop limit order. This one, as you can probably guess, combines the features of a stop order and a limit order. It's a two-step instruction that gives you way more control over the price you sell for during a downturn. So how does this work exactly? Let's break it down. Step 1 is the same. The stock price falls and hits your stop price. But, and this is the key difference, in step 2, instead of triggering a frantic market order to sell at any price, it calmly activates a limit order. You're basically saying, okay, if the price drops to $45, start trying to sell, but I absolutely refuse to accept anything less than, say, $44.90. So the difference really comes down to this. What's your priority? With a regular stop loss, you guarantee you'll get out, but you don't know the price. It's an eject button. With a stop limit, you guarantee the price you'll get, but you can't guarantee you'll get out at all. It's for someone who'd rather risk holding a falling stock than sell it in a total panic for a terrible price. I know, that was a lot to take in. So how do you actually choose the right one? Let's put this all together into a simple little checklist you can use to make the right call for your specific goal. It all comes down to asking yourself one question. What is my number one goal right now? If the answer is speed above all else, then you want a market order, but you have to be okay with not knowing the exact price. If your goal is a specific price or better, it's a limit order, but you have to accept it might never happen. If you just want to protect against losses, a stop loss is your friend. Just know the sell price isn't set in stone. And if you need both precision and protection, use a stop limit, but be aware it might not execute if the market is moving too fast. So if you remember anything from all this, let it be these three things. Number one, every single order you place is a specific instruction you're giving to the market. Number two, there is always a trade-off between the price you want and the certainty that your trade will actually happen. And number three, the right order type is always 100% based on what you are trying to accomplish. So now you know how to build your instructions for the market. But that brings up a really important question. What good is the world's most perfectly crafted instruction if there's nobody on the other side of the trade to actually take it? Next time, we're going to dive into liquidity and something called the bid-ask spread to find out. See you then.